In 2011, Groupon was one of the fastest growing tech companies in the world, revolutionizing the way we buy deals and services online. Fast forward to 2024, and the company is fighting for its survival, facing stock declines, mass layoffs, and potential bankruptcy. How did Groupon, once valued at over $12 billion, fall so far? And more importantly, is there still hope for a comeback? Today, we'll take a deep dive into the rise, fall, and possible future of Groupon. The rise of Groupon. Founded in 2008 by Andrew Mason in Chicago, Groupon offered an innovative twist on the traditional coupon model, combining local commerce with the power of collective buying. Consumers could purchase heavily discounted vouchers for goods, services, and experiences, but only if a certain number of people bought the deal, creating a sense of urgency and community-driven savings. This model quickly caught fire. Groupon became the go-to platform for local businesses looking to attract new customers. From restaurants to spas, the company provided an easy way for small businesses to drive traffic and for consumers to save on everyday expenses. By 2011, Groupon's explosive growth led to one of the most anticipated initial public offerings (IPO) of the decade. At the time of its IPO, Groupon was valued at over $12.7 billion, and its stock surged, marking one of the largest tech IPOs in U.S. history. The company's rapid rise wasn't just limited to the U.S. market. Groupon aggressively expanded into Europe, Asia, and Latin America, establishing itself as a global leader in the daily deals industry. By 2012, Groupon was operating in 47 countries and boasted millions of users. The fall of Groupon. However, Groupon's success story began to unravel almost as quickly as it had risen. There were several major issues that led to the company's downfall, starting with its business model. While Groupon's daily deals brought in a huge customer base, many businesses reported that Groupon users were one-time visitors who didn't become regulars. As a result, businesses began to sour on the platform, realizing that deep discounts and Groupon's commission didn't result in long-term customer loyalty. At the same time, Groupon's rapid expansion put immense pressure on its infrastructure. The company struggled with high operational costs, particularly in international markets, which contributed to its declining profitability. As Groupon spread into dozens of countries, the cost of running operations in so many regions proved unsustainable, and it began to pull back from some markets. Moreover, Groupon's attempts to pivot beyond the daily deals model were mostly unsuccessful. The company tried to move into product sales with Groupon Goods, a marketplace that offered discounted items such as electronics and home goods. However, Groupon Goods never took off as expected, and it struggled to compete with e-commerce giants like Amazon and Alibaba. In 2015, Groupon shifted its focus from rapid expansion to restructuring, pulling out of several international markets and laying off hundreds of employees. Despite these efforts, the company's revenues continued to decline. Groupon stock, once valued at over $26 per share, dropped below $5 by the end of 2015, signaling that investor confidence was eroding quickly, the current crisis and looming bankruptcy. Fast forward to 2024, and Groupon is now facing one of its most critical moments yet. In recent years, Groupon's struggles have worsened, and its financial situation has deteriorated significantly. The company reported steep losses and a dramatic decline in revenue. Between 2020 and 2023, Groupon laid off over 500 employees, shut down its Chicago headquarters, and watched its stock price plummet by over 99%. In early 2023, Groupon raised $80 million through a rights offering to stay afloat. But this infusion of cash has not been enough to stave off financial woes. In its most recent earnings reports, the company revealed continued losses and a bleak forecast for 2024, with flat to negative revenue growth expected. Groupon stock continues to trade at less than $2 per share, leading many to speculate that bankruptcy might be on the horizon. The COVID-19 pandemic dealt another significant blow to Groupon, with many of its deals centered on local experiences, restaurants, events, fitness classes. The platform was hit hard by lockdowns and restrictions that decimated its core customer base. Even after restrictions were lifted, consumer behavior had shifted dramatically, with more people shopping online for goods rather than returning to in-person services. What led to Groupon's collapse? There are several reasons behind Groupon's collapse, including 1. Reliance on one-time customers. Groupon's daily deals initially attracted a large number of customers, but most businesses found that these customers rarely became regulars. Instead, they took advantage of the deal and never returned, leading many businesses to abandon the platform. 2. Failed diversification attempts. Groupon tried to expand beyond daily deals into product sales and other services, but none of these initiatives gained enough traction to offset the declining revenue from its core business. Groupon goods failed to compete with established e-commerce giants. 3. High operational costs. Groupon's rapid global expansion put immense pressure on its infrastructure, leading to skyrocketing operational costs. When revenue growth slowed, the cost of managing operations in dozens of international markets became unsustainable. 4. Competition. Groupon faced increasing competition from other discount platforms and e-commerce giants. Larger companies like Amazon began offering similar deals, while local competitors took away market share. 5. COVID-19 pandemic. The pandemic wiped out much of Groupon's business, which relied heavily on consumers buying deals for local services. With restaurants, gyms, and event venues closed or restricted for long periods, Groupon lost a significant portion of its user base, and many of its merchant partners struggled to stay afloat. Groupon's attempt to avoid bankruptcy. Despite these challenges, Groupon has not yet filed for bankruptcy. The company is actively working to restructure and find a sustainable business model. In 2022, Groupon introduced a new strategy that focused on returning to its roots. Local commerce. The idea is to focus less on product sales and more on helping local businesses attract customers through deals and services. Groupon also implemented cost-cutting measures, including closing several offices and focusing more on its digital infrastructure. The company is now prioritizing mobile app improvements and online experiences, hoping to attract more customers through a seamless, user-friendly platform. Another potential lifeline for Groupon could be a merger or acquisition. There has been speculation that a larger tech company or e-commerce player might acquire Groupon's assets or user base, although no concrete offers have been made public as of yet. For now, Groupon is fighting to remain a viable business in a market where its original model has largely fallen out of favor. One key factor that could influence Groupon's future is its ability to leverage technology. With more consumers turning to online platforms for services and goods, Groupon needs to find a way to stay relevant in the e-commerce space. This could mean enhancing its app, building stronger partnerships with local businesses, or even integrating new technologies like artificial intelligence to offer personalized deals. What do you think about Groupon's chances of survival? Let us know in the comments below. If you enjoyed this deep dive into Groupon's financial crisis, don't forget to like, share, and subscribe to our channel for more insights into the rise and fall of today's biggest companies.